All right, let's dive right into this explainer and look under the hood of literally one of the most vital financial engines out there, the Nifty 50 index. Look, if you pay any attention to the financial world, you hear its name every single day. The market is up, the market is down, and 9 times out of 10, they're talking about this exact benchmark. But what actually is it? It's not just some random number flashing green or red on your screen. It is a meticulously engineered machine. And today, we're going to unpack exactly how it works.
So, at its core, that number, 50, represents an elite, well-diversified club of companies that are carefully selected to reflect overall market conditions. In a market packed with thousands of publicly traded companies, being part of this 50 means you are the absolute cream of the crop. We're talking about the titans, the heavyweights, that carry the broader economy squarely on their shoulders.
To really understand this barometer, we're going to break it down layer by layer. We'll meet the Nifty 50, look at how it's calculated, check out the strict eligibility criteria, take a peek inside the portfolio, and finally wrap up with index governance and maintenance.
Okay, part 1, meet the Nifty 50. Now, I know it feels like it's been around forever, but it was actually launched on April 22, 1996. The starting line, or the base date, was set retrospectively to November 3, 1995, with a nice, neat, round base value of 1,000. Today, it's computed in real time, pulsing literally every second the market is open. But why does this actually matter to us? Well, because it serves as the ultimate benchmark. Entire fund portfolios are measured against it. Trillions of rupees are tied directly to it through index funds, ETFs, and these complex structured products. Plus, it doesn't just come in one flavor. There are variants like the Nifty 50 USD for foreign investors and total returns indices that actually factor in dividends.
Moving right along to part 2, how it is calculated. So it's not just some simple average of a bunch of stock prices. The Nifty 50 uses a highly specific method called free float market capitalization. What does that mean in plain English? Basically, it means the index intentionally ignores shares that are locked in by promoters, governments, or strategic groups. It only measures the free float, the shares that are actually floating around in the open market, available for you and me to trade. This is absolutely crucial because it ensures the index is a true reflection of market reality, not just theoretical size. Which brings us to part 3, the strict eligibility criteria. Look, you don't just stumble into the Nifty 50 because you have a recognizable brand name. A company has to survive a brutal 3-step gauntlet to join this exclusive club. First off, they have to prove they're highly liquid, meaning their shares are super easy to buy and sell in massive quantities. Second, they have to be actively traded in the futures and options, or F&O segment. And third, they can't be a total newcomer. They need at least a 1-month listing history by the cutoff date. But let's actually zoom in on that first point for a second, the liquidity test, because it is fascinating.
This right here is the true bouncer at the club door, the liquidity rule. Market impact cost is honestly probably the best measure of a stock's true liquidity. Think of it as the hidden tax of placing a massive trade. Like, if you drop a giant buy order, does the stock price suddenly spike up against you? To get into the Nifty 50, a stock must maintain a remarkably low average impact cost of 0.50% or less over the last 6 months for a massive basket size of 100 million rupees, 90% of the time. This guarantees to major institutional investors that they can jump in and out of these stocks efficiently without swinging the market price too much. All right, let's pivot to part 4, inside the index portfolio. Usually, when people think of a diversified index, they picture, nice, even slices of a pie. Well, not here. Financial services completely dominate the landscape, carrying a massive 37% weight in the index. The next closest, oil, gas, and consumable fuels at about 9.8%, IT at 7.4%, and automobiles at 6.7%. The remaining 39% or so is chopped up among all the other sectors like healthcare, telecom, and consumer goods. So, long story short, if the banking and financial sector has a really bad day, the Nifty 50 is going to feel it, and feel it deeply. And that concentration becomes even crazier when we look at the specific heavyweights pulling the cart. Just 5 companies make up roughly 37% of the entire index. Institutions like HDFC Bank sitting at over 11%, ICICI Bank right behind at 9%, and Reliance Industries at 8% clearly lead the pack. When you invest in a Nifty 50 index fund, a massive chunk of your money is actually going directly into just these top few titans. Finally, part 5, index governance and maintenance. So, an engine this powerful, Literally dictating where trillions of rupees flow requires constant tuning and a highly disciplined crew to keep it running smoothly. The market is always changing, so the index has to evolve too. To keep it reflective of the current reality, it undergoes a strict semi-annual rebalancing. The hard cutoff dates are January 31st and July 31st. And they don't just look at a quick snapshot of a single day either. They look at average data from the full 6 months leading up to those cutoffs to make sure a company's performance wasn't just a flash in the pan. And crucially, there's no shock factor here. The market is given 4 solid weeks of prior notice before any roster changes are officially made. Now keep in mind, the Nifty 50 doesn't just operate in a vacuum. It's actually the flagship in a massive, sprawling fleet of indices managed by a dedicated professional team at the NSE. There are broad market indices, thematic ones, fixed income, specialized sectoral indices. It's this vast ecosystem designed to track every conceivable heartbeat of the economy. With all that responsibility, you gotta wonder, who is actually keeping an eye on the shop? Well, to guarantee the accuracy and reliability of this extremely complex system, every single move is overseen by a rigorous 3-tier governance structure. You've got the Board of Directors of NSE Indices Limited at the top, supported by the Specialized Index Advisory Committee for Equity and the Operational Index Maintenance Subcommittee. This separation of powers makes sure that the benchmark remains totally impartial, objective, and mathematically pure. So as we wrap up this explainer today, I want to leave you with something to chew on. We so often treat the index as a perfectly balanced scale, but we've seen today that it heavily favors specific giants and very specific sectors, all governed by incredibly strict liquidity rules. Knowing how rigidly this index is weighted and governed, how might a sudden shift in the Nifty 50 change how you view the health of the overall market? Like, does a drop in the Nifty mean the whole economy is suffering, or just that a couple of heavyweight financial banks had a rough week? Understanding the mechanics of this elite 50 company club really should shift your whole perspective on the financial world. Thanks so much for joining me on this deep dive.